The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast. How's it going, everybody? Welcome back to Trajecta Talks. I'm your host, Alex Savanovic. And for those of you who are new, I'm an experienced hedge fund trader. And this podcast is all about demystifying the world of finance for you, the next generation of leaders, innovators, and investors. I'm so glad you're here. So, whether you're listening in your dorm room or maybe you're on your way to class, just trying to figure out what's next after high school. My goal with this podcast is to equip you with the knowledge and the confidence to build a solid financial foundation and make smarter money decisions. So, today we're embarking on a crucial and often overlooked aspect of finance, the psychology of risk taking. This isn't about market analysis or specific investment strategies. It's about understanding the most powerful and unpredictable variable in any financial decision. Your emotions, biases, mental states, they all profoundly impact your trading and investing outcomes. This is such a vast and complex topic that we'll be breaking it down into two different parts. So that's today's episode. We'll also have another one. Today's just going to be an introductory discussion. In a future episode, part two, we'll dive even deeper into specific psychological techniques and advanced mental models, things that I use pretty frequently to get through the trading day, especially when I want to rip my hair out some days. Now, before we embark on today's discussion, we have to start with my personal favorite part of the episode, the weekly market update. Pretty fitting for today's discussion on psychology. There was no shortage of mania in the tape this week. So let's get right into it, talk about some of these things. So, first up, let's talk about the fresh crop of new public offerings making their debut. While we haven't seen them actually open for trading yet at the time of this recording, the syndicate desks buzzing, couple of notable deals this week. So, quick pause. When I was writing this for this episode, we hadn't seen Bullish actually open. MIAX, that's Miami International Holdings, we'll talk about. That's the financial exchange operator looking to price its $300 million IPO in the range of 19 to 21. Could price above that range. That one happens tomorrow. Bullish, which I was just talking about before, I just watched it open at $90, trade up to 115, I think back down at 97. It's a crypto exchange aiming for a much larger splash with its nearly $1 billion offering targeted to price in the range of 32 to 33. Now, if I'm remembering correctly, I think it priced at the top end of that range or maybe even higher. It's clear the market has an appetite for these new issues. We'll be watching closely once they hit the boards. Like I just said, Bullish opened, absolute rocket. We'll see about MIAX tomorrow. Just want to quickly note that this appetite in the market for these IPOs, the recent successes, there's been a few that have worked really well. A few weeks ago, we saw Circle have an incredibly strong IPO, raised $1.1 billion. That deal was way oversubscribed. This is a really positive sign for the market, the tape in general. Seems to have set a bit of a precedent. Then we saw Fig last week. Was Fig last week? Maybe Fig was 2 weeks ago. Same thing, opens way above where they priced this deal. Trades way higher the days following. I was actually mentioning to a colleague that some of these super hot IPOs, they get 20, 25, 30 times oversubscribed. It's maybe not the worst idea in the world to put out a market on open order, buy a few hundred or a few thousand shares and trade it for one day. They all seem to trade up 10, 20, 30 points on the day of the open. Just an idea, not investment advice, but it's something I thought about doing. Now shifting gears to the macro, we had the consumer price index CPI report this morning. That was yesterday morning, sorry. Certainly made some waves. July CPI rose by 0.2% month over month on a headline basis and 0.3% on a core basis. Year over year basis readings were 2.7 and 3.1% respectively. However, 6 month annualized rate of inflation was a more subdued 1.9%, for headline CPI and 2.4 for core. So these figures suggest that the Federal Reserve could resume its easing cycle with a rate cut at the next meeting in September, assuming we don't get a shocking upside surprise in maybe the August CPI or an overly strong August jobs report. Following this economic data, we saw some immediate pressure on the fixed income side. Bonds definitely took a hit. Yields were undeniably climbing in the aftermath of the print. It's a reminder to us that even subtle shifts in inflation data can translate directly into a tightening in the bond market. So, turning our heads over to corporate performance, the earnings cycle brought some pain to the software sector. Monday.com, that's MNDY, for instance, really got dinged yesterday. 2 days ago on Monday, funnily enough. After their earnings report, we observed that some other software names also saw sympathetic selling pressure, underscoring the interconnectedness of these high growth cohorts, especially when you take a look at cyber. All the cyber names typically tend to trade together, and software in general, except Adobe got a bid that morning, which is odd. And speaking of pain, C3 AI, the ticker on that one's AI, absolutely blew up on their report last Friday after the close. And just a quick asterisk on this one, it always feels a bit unusual for me personally when a company slips out results after the market shutters on a Friday, almost like they're trying to bury something or hide it. Nobody's watching on a Friday afternoon. And in this case, the market reaction absolutely validated that suspicion. The stock got absolutely smashed, a direct consequence of their notably poor performance revealed in that report. So, with that, couple good ones there, folks. That brings us to the close of this week's market intel. Let's get right back into today's discussion. So, fundamental discussion, let's start with that today. Why does psychology play such a massive role in trading and investing? You might think that success in finance is all about crunching numbers, understanding economic reports, analyzing charts. Maybe it's doing fundamental analysis, technical analysis, understanding stocks, whatever you think it is. And while those are all undoubtedly essential skills, they really only tell half the story. The other half, the one that often determines consistent success or repeated failure, lies squarely in the realm of psychology. I can tell you that firsthand because it was a big part of my trading I struggled with for a long time. So I want you to think about it. The market is a reflection of collective human behavior. Every price movement, every rally, every crash is ultimately the result of millions of individual decisions driven by both logic and emotion. If you can't manage your own emotions and reactions, how can you possibly navigate such a dynamic and often irrational environment? And I want to really put that in bold, underline it. The stock market is very often an irrational environment. The reason psychology is so critical is that financial markets are inherently uncertain. You can never know with 100% certainty what will happen next. This uncertainty triggers some of our primal responses as human beings. When we perceive opportunity, we feel excitement and greed. And when we perceive threat, we feel anxiety and fear. You've probably heard that greed and fear thing mentioned by people on CNBC before. These emotions, if unchecked, can override even the most well thought out trading plans. They can lead you to buy the top, sell at the bottom, hold onto a losing position way too long, or exit a winning position way too early. It's a constant battle between your rational mind and your emotional impulses, always. Another reason that psychology is paramount is that, excuse me, it's that investing and trading often involve delayed gratification. You put in the work now, that is the research, the analysis, the disciplined execution, you finding your edge, you applying that edge. You do all of those things for a potential reward in the future. Our brains, however, are often wired for immediate gratification. This can make it incredibly difficult to stick to a long-term plan when short-term temptations or frustrations can arise. So discipline, patience, and the ability to accept small losses in pursuit of larger gains are all psychological traits. Moreover, The financial markets provide instant, continuous feedback on your decisions, often in the form of monetary gains or losses. This direct feedback loop, I guess we could call it, can be really intoxicating when you're winning and devastating when you're losing. Uh, I know from experience when I first started doing this and I did it absolutely unchecked, it 100% amplifies emotions, creating a roller coaster experience that only the most psychologically resilient individuals can navigate consistently. It takes a lot of discipline to do that. So I mentioned it earlier a little bit. Let's talk about the two titans of trading psychology. That's fear and greed. These are the most powerful emotions that drive market participants, and understanding their influence is the first step toward mastering your own financial decisions. Fear, if you don't know this already, is a survival mechanism in humans. In the wild, fear keeps us safe from danger. In financial markets, fear manifests as the apprehension of losing money. This can lead to a host of irrational behaviors. For example, panic selling occurs when fear becomes widespread. Imagine a stock you own starts dropping rapidly. Your mind might scream, get out, protect your capital, protect yourself. This can lead you to sell at the worst possible time, locking in losses that might have recovered had you stayed calm and rational. That's more of a investing sort of way of thinking. We'll talk about it a little bit differently when it comes to trading. Fear can also lead to regret aversion, where you avoid making the decision that might lead to regret later, even if it's the right move. So, this might mean holding on to a losing stock because selling it would mean admitting you made a mistake. And the pain of that admission is greater than the pain of continued losses. For some folks, being wrong hurts more than losing a boatload of money. And that might be true for you. Fear is often amplified by the herd mentality. When everyone around you is panicking, selling, it becomes incredibly difficult to stand against the tide, even if your analysis tells you it's the wrong move. The fear of being wrong or the fear of missing out on the mass exodus can be overwhelming at times. So now let's flip that coin and talk about the opposite end, which is greed. Greed is the intense desire for more to maximize gains, while a healthy desire for profit is essential for investing and trading. Unchecked greed can be just as destructive as fear. Greed often kicks in during bull markets or when an investment is performing exceptionally well. It leads to overconfidence where you start to believe that you can't lose. This can lead to taking on excessive risk, over trading, or abandoning your carefully planned strategies in pursuit of even bigger, faster profits. Greed can also manifest as FOMO, or the fear of missing out. When you see others making huge profits on a particular stock or asset, greed can compel you to jump in, even if the valuation is astronomical and the fundamentals absolutely do not support the price. We've definitely seen a little bit of this with AI, I feel like. And one of the stocks that just comes to mind randomly is Palantir. I don't know if you've seen the price action in that stock. Fundamentals completely disconnected from price action. This sort of stuff often happens right before a bubble bursts. Now, you don't want to be the one left behind, so you buy it at the peak just as the smart money is exiting whatever it is that you're buying. This little dance that we do between fear and greed creates the boom and bust cycles that have characterized financial markets throughout history. A market driven by greed can spiral into euphoria where rational decision making is completely abandoned. Now, that word euphoria, I want to delve a little deeper into that. Euphoria in the stock market and mania in various segments of the market. These are extreme psychological states that lead to massive mispricing of assets and inevitably spectacular crashes because things eventually get to a point where they make zero sense, and then we got to sell them, revert back to the mean where valuations do start to make a little bit more sense. Market euphoria, it's a state of like exaggerated optimism and confidence among investors. Typically occurs during the late stages of a bull market where asset prices have risen significantly for an extended period of time, a few years maybe. In a state of euphoria, investors become completely detached from fundamental valuations. Some would even say delusional. They believe that prices will continue to rise indefinitely, driven by an almost irrational exuberance. Any sort of rational analysis is really quickly replaced by hype, speculation, the belief that this time it's going to be different. New investors flock to the market, often with little understanding of what they are buying, simply because they see others, excuse me, uh, just getting rich. The media doesn't really help. They definitely fuel the fire, highlighting success stories, downplaying risks. I absolutely hate to see Michael Saylor getting on CNBC to talk about MSTR and what he's doing. We can make a whole nother episode on that. But these crypto treasuries might be the silliest thing I've ever seen. Definitely can save that for another episode. But them getting on CNBC and these Bloomberg TV, whatever it is, might be the top. Um, think back to the dot-com bubble for quick second. Late 1990s, internet companies, many with no profits or even clear business models, saw their stock prices soar to astronomical levels. Investors caught in the euphoria poured money into anything with a dot-com suffix. It was insane, truly. The belief was that the internet would change everything, which it did, but the valuations at the time were utterly detached from reality. When the bubble burst, countless investors lost fortunes. And that's just not your big name investors. That's tons of people with money in pension funds, for example, retirement funds, whatever. A lot of people got hurt. Similarly, mania can grip various segments of the market. This is an even more intense form of collective irrationality, often focused on a particular asset class or industry. So, a couple historical examples of mania. There was the tulip mania in 17th century Netherlands, perhaps the most famous historical bubble. We definitely all learned about it at university. Tulip bulbs, just a flower, became speculative assets. Prices soared to unimaginable heights, with some rare bulbs trading for more than the cost of a house. People mortgaged their homes and invested their life savings, driven by the belief that prices would never fall. And of course, they eventually did, leading to a widespread financial ruin. Another famous bubble, the housing bubble of the mid 2000s. If you've seen The Big Short or any movie similar or documentary, in the years leading up to 2008, there was a widespread belief that housing prices would always go up. People were taking out mortgages that they couldn't afford, buying multiple properties, flipping houses with reckless abandon. The mania was driven by easy credit, perception of housing as a guaranteed investment, which it absolutely is not. When the bubble burst, it triggered the global financial crisis that we've all heard about. And more recently, segments of the cryptocurrency market have experienced mania, I think, and even some parts of AI have definitely experienced mania. While cryptocurrencies represent a fascinating technological innovation, maybe, there's periods of extreme price surges driven by hype, speculation, rather than fundamentals. My personal thing with crypto coins is I think people saw stories of quick riches and jumped in, often without understanding the underlying technology at all or inherent risks. Only to experience sharp corrections. So, what sort of things characterize periods of euphoria, mania? Obviously, one of them that we've talked about frequently now, rapid price appreciation, assets surge in value far beyond what fundamentals would suggest. May increase speculation. People buy not for long-term value, but with the sole intention of selling at a higher price quickly. Broad public participation is always an interesting one. There's a saying that a few of my colleagues in New York say often: if your barber's telling you about a stock, it's probably time to get out. Even individuals with no prior investing experience jump in, often borrowing heavily to do so. That's sort of what that means, the barber analogy. Another sign that it might be time to exit the party: real rationalizations of high prices. Analysts, commentators invent new theories to justify the exorbitant valuations, often claiming that this time it's different. Adam Jonas talking about Tesla being the biggest Tesla bull for the last few years is a prime example of this. Came up with a new reason every week, it felt like, to talk about why Tesla was going to 1,000, going to 800, whatever it was. So the goal with this sort of stuff is not to predict the exact top or bottom, but to recognize the psychological cues that suggest caution is warranted. When everyone is euphoric and the taxi driver is giving you stock tips or the barber is giving you stock tips, it's often a sign to be wary. So, given the profound impact of psychology on financial decisions, it's no surprise that many experts have dedicated their careers to understanding and teaching it. So I want to take a moment here to recommend two foundational books that have significantly shaped my own understanding and approach to the markets. These are, in my opinion, must reads for anyone serious about mastering their trading and investing mindset. So the first, I don't know if you remember back to the episode where I had Ethan White's on the pod. He mentioned Trading to Win, the psychology of mastering the markets by Ari Kiev, Dr. Ari Kiev, that is. He was a psychiatrist who worked with top traders, including legendary Steve Cohen, applying principles from sports psychology to the trading arena. His book emphasizes that consistent success isn't just about intellect or knowing the market, it's about developing mental and emotional stamina. Now, what I loved about that book was the many parallels that I didn't realize existed between sports and trading. As someone who grew up an athlete, that made the book very easy to read for me. So, some of the key ideas from Trading to Win: overcoming self limiting beliefs. I think Ari argues that many traders are held back by deeply ingrained, often unconscious beliefs about money, risk, success. These beliefs can lead to self sabotage. For example, a belief that money is evil or I don't deserve to be rich can subconsciously cause a trader to make bad decisions that lead to losses or things that self sabotage their trading a little bit. So the book provides tools, for example, to identify and overcome these limiting beliefs, replacing them with empowering ones. The book also talks about managing fear, self doubt, and greed. Those three things mm, can be the biggest hindrances to your trading longevity. The book provides strategies for staying focused and calm in the face of market volatility. I know a lot of people freeze up when they see that. It emphasizes that master traders possess an edge that keeps them from being distracted by these emotional components, which can cause major losses or prevent gains. It's about recognizing these emotions when they arise and having a predefined response to prevent them from making you do something stupid when you're trading. Next up, we have, they spoke about in the book, acceptance of uncertainty and risk. This was also a big topic in the other book I'm going to tell you about. Trading is obviously a realm of uncertainty, and Dr. Kiev highlights that successful traders have the confidence that probability is on their side. That's what your edge is. Even when you're faced with individual losses, they understand that trading involves taking calculated risks and are comfortable with the inherent randomness of individual outcomes. We can definitely get into this in part two, but this is basically how casinos make their money. They're not worried about you winning one hand of blackjack. They really don't care at all. You know, Instead, they're going to focus it on longer term probabilities. The second essential book is Trading in the Zone: Master the Market with Confidence, Discipline, and a Winning Attitude. This is by Mark Douglas. The book is widely considered a classic in trading psychology, and for good reason. I'm currently reading it again, actually. Douglas's core message is that consistent trading results come not from superior market analysis, but from mastering your mindset. This book is very, very similar to the one that was written by Ari Kiev, but they have slightly different perspectives. And I think if maybe you're not the right person to read Dr. Ari Kiev's book for whatever reason, maybe his writing is difficult to understand, you definitely will have a better time with Mark Douglas's book. So I'm not going to get into all the intricacies and specifics on what he talks about in that book because it tends to be quite similar to the first book I recommended. But definitely check that out. Check out both of them, especially if you're struggling with some psychology stuff as it relates to trading. So, in addition to these foundational concepts, it's important to consider other psychological factors that often influence risk taking as well. So, one of the significant ones is confirmation bias, which is the tendency to seek out, interpret, and favor information that confirms your existing beliefs while ignoring contradictory evidence. So, if you're bullish on a stock, you might only read articles that support your optimistic view and disregard any negative news. This can lead to a dangerously one sided perception of reality. I remember a few months ago when all the quantum stocks were absolutely ripping, everyone was reading about how great quantum was going to be for the future and how we needed all these other auxiliary technologies in order to support that ecosystem. And then a few weeks later, everyone was like, the breakthrough that Google had is not even really a breakthrough. It's like a tiny little thing. Again, I'm no quantum mechanic or physicist or scientist, whatever you want to call it. I have no idea about anything quantum, but I did think it was funny how somebody burst the bubble a few days later and Google's stock fell. Anchoring is another bias where people rely too heavily on the first piece of information they receive when making decisions. For example, if you see a stock trading at 100 bucks and it drops to 50, you might anchor to that $100 price, which is super dangerous, and perceive the stock as cheap at 50 bucks. Even if its fundamental value has deteriorated significantly, maybe that stock is really only worth 25 bucks. Who knows? It depends on the valuation methodology, depends on who's trading in that market. Understanding these biases isn't about eliminating them entirely. They're there for a reason. That's almost impossible to ever eliminate them. They do exist, but you're supposed to be aware of them and building mental safeguards to mitigate their impact. And that a lot of those two books I recommended before talk about that a little bit. This is where a disciplined trading plan, clearly defined risk parameters, and continuous self reflection become invaluable. So, as we get to the end of this conversation, I think it's crucial to understand that while the principles of trading psychology are universal, the process of mastering them is a deeply personal journey, and it looks different for everyone. We're all unique individuals shaped by our distinct personalities, life experiences, and even our neurobiology. No two people are the same. What works for one trader might not work for another, and acknowledging this individuality is key to your long term success. I'm pretty sure you'll find something valuable in those two books that I recommended, but you might not. Maybe they're not for you. And maybe you find another book that really clicked for you and helped you climb out of whatever hole that you're in mentally. Your personality traits, they play a significant role in how you approach risk and react to market fluctuations. So are you naturally more risk averse, or are you naturally a risk taker? Are you highly impulsive? Maybe you shouldn't trade if you're highly impulsive. Or do you tend to overanalyze? Are you an optimist or a pessimist by nature? For instance, someone who is naturally very, very cautious might struggle to pull the trigger on a really valid trade signal. Maybe they're fearing potential loss. And conversely, someone who's overly confident might take on way too much risk, driven by a desire for quick gains and to make money. So, understanding your inherent tendencies, perhaps through personality assessments or simply deep self reflection, meditation, doing yoga, these mindful sort of activities where you can be with yourself and learn about yourself. They really allow you to tailor your approach and implement safeguards that work for you. Because again, the safeguards that I need when I trade are not going to be the same for anyone else. Furthermore, your lived experiences profoundly shape your financial psychology. If you grew up in a household that experienced financial hardship, you might develop an extreme aversion to risk. And even if it means missing out on significant opportunities and gains, if you've had a quick string of successes early in your investing journey, you might develop like this inflated sense of your own skill. You think you're the man, you can go in there and make money at will. It 100% will lead to overconfidence. Unfortunately, past losses can also create deep seated fear that paralyzes future decision making. Even your cultural background or educational experiences can instill certain biases about money, wealth, and risk. So it's important to take into consideration who you are as a person holistically and your experience over the course of your life to really define and tailor an approach that fits for you. There's no one size fits all magic formula for perfect trading psychology. The work of mastering your own mind is an ongoing journey of self awareness and adaptation. It's one that I'm still on, I'm getting better at, but I'm nowhere near perfect. Nobody is. But a couple tips that I can maybe share: honest introspection. You're not going to get anywhere by lying to yourself. Regularly check in with yourself about your emotional state before, during, after trades. What feelings are present? What biases might be at play? Journaling has been a cornerstone of my trading journey. I have 7, 8 journals. I journaled every single day that I've ever traded, documenting not just your trades, but your thoughts and emotions surrounding the trades. What were you feeling during, before, after the trades? When you lost money, how did you feel? When you made money, how did you feel? Everything. Another tip, you might find that you really benefit from a mentor, so seeking mentorship, if it's appropriate for you, sometimes an outside perspective from an experienced, psychologically balanced trader can help you identify some blind spots. And maybe it doesn't even have to be someone who is a trader in the trading community, but a psychoanalyst or therapist or a counselor can really help sometimes massage out of you some things from your past that might be inhibiting your trading. Ultimately, the goal isn't to become emotionless robots. Emotions are a part of the human experience. The goal is to develop the emotional intelligence to recognize these feelings, understand their potential impact, and consciously choose to act in alignment with your rational trading plan rather than being swept away by fear, greed, or other biases. Your unique path to consistent profitability lies in understanding and managing your unique psychological landscape. This introduction to the psychology of risk taking is just the beginning. It's a journey of self discovery as much as it is a journey of financial mastery. The more you understand your own mind and its tendencies, the better equipped you'll be to navigate the unpredictable waters of the financial markets. In the next part of this trading psychology series, we'll delve into more specific techniques for cultivating a winning mindset, including mindfulness, journaling, advanced behavioral strategies as well. And I bet you thought I was going to forget my second favorite part of the episode is going through stock picks. So we only had one submission this week. It was an interesting one. Let's break it down. Let's get right into it. So this one was submitted by, looks like Anonymous, didn't include a name, listener on Friday right after the market close. The stock pick is a long position on an ETF, actually, not an individual stock. Ticker symbol PSQ. For those of you who might not be familiar with PSQ, PSQ is a ProShares short triple Q ETF. So, in plain English, because I know that was probably gibberish, this ETF aims to provide the inverse of the daily performance of the NASDAQ 100 index. So, if the NASDAQ 100 goes down by 1%, PSQ is designed to go up by 1% and vice versa. It's an inverse ETF. So basically a way to short the Qs, the ETF that tracks the NASDAQ 100 without having to actually short the stock yourself. So it's a great tool for those who think the market and specifically the big tech stocks might be headed for a correction. Our anonymous listener submitted this pick at a price of about 32.5 on Friday. As of this recording, let's look at the I can't see from here, but I think it's about 32.30 or maybe a tad higher today, which is just a slight decline. It seems like the NASDAQ 100 has continued its upward trajectory. And as a result, our long position on PSQ is currently a little bit in the red. This highlights the risk of these inverse ETFs as the general market trend often is to the upside, and it has been for quite a long time. Our anonymous listener might be a little early on their call for a market downturn, but we'll be watching it closely, hoping it turns around for our anonymous listener. It's a bold move to bet against the tech giants right now, especially with everything making fresh all-time new highs. So we appreciate the gutsy submission, and we'll see how it plays out in the coming days and on next week's pod. And I just want to add, we at the fund actually tend to agree with the sentiment behind this call being long PSQ. While we're not entirely bearish on tech and the AI revolution long term, we think it'll be a really helpful thing for society. We think the party and the stock market at least might have gotten a little carried away, a little too quickly. Valuations of some of these companies have gotten incredibly stretched in a very short period. So while the long-term prospects for AI and these tech leaders are still very bright, a short-term pullback to maybe bring valuations back to earth seems entirely plausible, reasonable, and even healthy for the market. So in trading, your idea is either wrong or your timing's wrong. And this anonymous submission is a great example of trying to get ahead of that potential shift in sentiment, but maybe the timing being a tad off. So folks, that's all the time that we have for today. Thank you so much for joining me on Trajecta Talks. I hope you found this introductory discussion on the psychology of risk-taking to be insightful and empowering. If you want to stay connected and continue your learning journey, be sure to follow us and our sponsor, Trajecta University. You can find us on Instagram, LinkedIn, Facebook by searching for Trajecta University. University or Trajecta Talks. All the links are also in the show notes below. And if you want, check out our YouTube channel if you prefer to watch the episodes. There's tons of great content on all of the pages. Links for everything are in the show notes below. So until our next episode, next Friday, keep learning. Please keep investing in yourself. Keep building your future. Work on that trading psychology, identify the lapses in your mental framework. I hope you all have a fantastic Friday. Take care, and I'll catch you next week.